Hey everyone, today on the final bar, catching up with Erin Swenlin from DecisionPoint. We'll hear what charts are top of mind for her as we look at this choppy market environment. Yesterday, we saw quite a bit of a rally going into the close. Today, a choppy day that netted more to the positive. The S&P bouncing right up to 4,000, big round number, coming right to the downside. Some of the offense, like consumer discretionary at the top of the list, defense at the bottom. What does this mean versus an overall recovery? Ladies and gentlemen, this is the final bar. Hi, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical analysis toolkit is really designed to help us understand investor behavior, sort of manage our own behavior by giving us a way of making disciplined decisions, taking the emotion out of the decision-making process, but also taking advantage of a broader understanding of investor psychology other than our own, right? Thinking about what other investors are doing and how their sentiment, how their emotional state is best reflected in measures of price and breadth and sentiment. We actually have Erin Swenlin in the StockCharts headquarters today and tomorrow. So we actually sat down with her a little earlier, talked about a bunch of things, some great content we'll be sharing with you over the next couple of weeks, if not next couple months, but we also talked about some key charts to pay attention to today. We're going to share that discussion with you a little later in today's show. We have great guests, as always, coming through the final bar. I want to share with you just what's coming up next week. So on on Monday the 30th, we have the market holiday for Memorial Day. So I wish everyone well and in taking that time off and celebrating and giving thanks for those that have given their lives for us. On Tuesday, the 1st, Dave Landry from DaveLandry.com will be joining us from Louisiana. On Wednesday, June 2nd, Jay Pettit from Charts Avenue will be coming on the show. Let's continue on with today's episode. Let's focus on the markets. It is a choppy day among choppy weeks, among choppy months, and let's break down the price action and see what actually transpired through the course of the day. Not a bad day overall in terms of the overall movements. The S&P finishing up about 1%. Now, earlier in the day, in the late afternoon, just after 3 p.m. Eastern, got right up to 4,000. We've talked often on the show about big round numbers. They matter. We can debate why they matter, how they matter, whatever. I will tell you, having done this for quite some time, prices tend to fluctuate around big round numbers, and that's just because as humans, we gravitate toward those. The level 4,000 doesn't mean much to the S&P 500. It does mean something to individual investors, institutional investors, and that's why the markets tend to revert or tend to have swings and find support and resistance around big levels like 4,000. So not surprising that we rallied right up to that point and then turned off and pulled back about 20 points into the close. The NASDAQ pushing higher after struggling in recent weeks, certainly leading the way to the upside, up 1.5% for both the NASDAQ Composite and the NASDAQ 100. The mid-cap and small-cap S&P indexes doubled the returns of the S&P. The S&P 600 small-cap index up over 2% today. VIX remaining below 30, so just above 28.30 today. Other asset classes here very quickly. Interest rates, choppy day. At the end of the day, didn't really make up much ground one way or the other. 10-year yields not too far off of where we finished today. Yesterday, around 275. 30-year yields, the long bond yield remaining below that 3% level, just below it around 297. Bond prices a little higher using the TLT, and the dollar index using the UUP. Nice bounce after showing some short-term weakness for sure. Commodities overall strong, but the precious metals part of that, and even industrial metals like copper, all coming off a bit. Not huge swings relative to what we have seen at times on for the commodity ETFs that we track here, but overall netting out to a positive at the DBC up 0.7%. Cryptocurrencies continuing to be unable to mount any sort of meaningful move to the upside. If you're bullish on cryptocurrencies, which I would describe myself as bullish on cryptocurrencies for the long term, I think Down the road, I would not be surprised if Bitcoin is higher than where it is now. The challenge is in the short term. And when you think as a technical analyst, you think about the long-term trends, and you also think about the short-term situation and other timeframes, depending on where you're, what timeframes you're actually playing on. The reality for Bitcoin is that it is struggling to get any sort of momentum above 30,000. If you're looking at Ethereum, it's struggling to get anything above 2,000. Until those things happen, until those coins can get above those significant resistance levels, it's hard to think of them as anything but discouraging here, anything but distributive, right? Accumulation, I mean, influx of buying power would push those coins above key resistance levels. It has not happened yet. Let's look at a chart of the S&P 500, then we'll come back and check on some sectors and some thematic moves. We're going to do a segment later in today's show on market breadth, so I don't want to go too deep into that. We'll talk about some of the other key takeaways here. If you look at what's happened in the last couple of weeks, here's how I would describe the overall trend in the S&P 500. So my market trend models we talked about on Friday's show, and if you missed that one, it was a really good one, I think, because we took a look at really the key metrics, right? Those key measures of price, breadth, and sentiment. My market trend model, long-term, medium-term, short-term, all bearish right now and remaining. So I updated every Friday. So for this week, still remaining negative. Now you've had a bit of stability here, right? So we made a new low on, what was that, Friday of last week. We made a new intraday low, but closed a little bit above the previous low. We never really closed below 3,900. If so, just not more than a couple ticks below there. And from there, we're showing some signs of life here. So we've had a couple days on Monday and now today on Wednesday session where we're closing far above the open. So a nice upward move, a nice open candle. If you look at candle charts, the other two bars, Friday's bars was sort of a hammer candle. Yesterday's bar, we call it dragonfly doji, which is basically sort of like a hammer, but you have the open and close almost at an identical level, big, long lower shadow, limited upper shadow, and that is a sign of short-term accumulation. So you have these bottoming candle patterns as the S&P has tested for the first time since March of 2021, the 3,800 level, right? So and call it 3,815, 3,820. Those are the Fibonacci retracement levels we've been talking about for quite some time. So the base case we've been talking about is a down move to 3,800, some sort of bounce off of that level. And I think you may be seeing the beginnings of potentially something a little more significant to the upside. Overall, the long-term trend certainly remains fairly weak and some individual names showing some bouncing. But, you know, when I ran a scan earlier today for my market misbehavior premium members, 56 stocks making a new 3-month high, 127 making a new 3-month low. Now, well, that's a little more even. It's still to what, 5 to 2, 2.5 to 1 in terms of the ratio of new highs to new lows to new highs. So still favoring, obviously, many more stocks making new 3-month swing lows than making new 3-month swing highs. So overall, that, you know, there's a lot to go before the market really shows signs of a recovery where you'd really expect further upside. And to be honest with you, I think with the recent bounce up to just below 4,100, I think you have to get above there, which would be a new swing high to indicate any sort of lasting, more significant up move, right? You get above there, I think you have to look to the 4,250, 4,300 level. That'd be about the 50-day moving average. That'd be a former area of resistance. That could be an interesting level to look at. But again, I'm skeptical given all the negative considerations that we've seen. What also concerns me about this chart of the S&P 500 is what does that look like if and when the S&P closes below 3,800? And the short answer is not great, right? That would be a follow through to the downside. That would be a relatively painful development. Let's go back to the dashboard page and see how the sectors performed. This was really sort of a different look than what we've seen recently. A lot of the days recently, we've seen the defensive stuff like utilities, consumer staples, healthcare. These are the sectors I've been talking about as showing signs of strength. These are the stocks that have been outperforming recently. This is where when I'm scanning for stocks showing improving trends, this is where I'm finding a lot of them. For example, in consumer staples, things like the tobacco stocks rotating higher. In utilities, a bunch of names, just the sector as a whole, showing strong relative strength in the last 6 months, we'll call it. But overall, those today were on the bottom of the list. It was defense at the bottom and more offense at the top, to be honest. Consumer discretionary, the XLY, up 2.8%. Energy, up 2%. Communication services, up 1.4%. You know, it's interesting when we look at, when we talk about energy, you know, and again, I get so many questions in this sort of move. It's gone up so much. It's outperformed the S&P so dramatically over the last 6 months, how can that be sustainable? Is it too late? And I've literally been asked all along this way, is it too late? Is it too late? Is it too late? Is it too late? And the answer has been no, no, no. And I would argue still now, no, right? The whole essence of trend following is that you follow trends. You lean into what's working. Energy is working, and it's not just the broader sector. You're finding individual names that are starting to roll over, or starting to continue to break out. The top ranked name out of our entire large cap universe is in the energy space. Most of the top 10 stocks are in there. It's things like DVN and Oxy, and this one, which is called EQT Corp, ticker EQT. This is the top ranked stock in our large cap scooter rankings, making a new 52-week high again today. And that's after what we would call a bull flag pattern, a big run higher, a parallel decline, the counter trend move to the 50-day, and then breaking out to the upside, making a new high. If you take this measurement, the trend leading up to that consolidation, that measures a lot higher than where we are now. We need to take a quick commercial break. We'll be back with my next segment, talking to Erin Swenlin. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the activity in these markets using the power of stock charts. We are here to help you as you try to make sense of these markets in uncertain times. One way we can hopefully add value is through our mailbag. The Final Bar mailbag is always open, and we answer questions twice a week, once on Tuesday's show and then at the end of the week on Friday's show. You can get your questions to us one of three ways. Via email, thefinalbar@stockcharts.com. Via Twitter, just tag us in a comment at FinalBarSCTV. Via YouTube, put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That's our on-demand platform. Special events like the pitch, our Stock Charts draft, which occurred last month in April, our mid-year outlook, which is coming up in June, July. So much great content for free every trading day at StockChartsTV.com, or on your mobile device. Just search for Stock Charts TV on demand. I want to share with you here in a few moments an interview I just did a couple hours ago with Erin Swenlin. Erin's works at DecisionPoint. She's the technical analyst there, along with her father, Carl Swenlin, who started DecisionPoint and really was a mentor for her in many ways in terms of understanding the market environment. Talked with Erin about a lot of different things, about how she grew as a technical analyst, what her routines are, and all sorts of technical indicators, books she'd recommend. All of that we'll be sharing with you over the next couple of weeks on Stock Charts TV. But I do want to share with you, because I asked her what she was looking at now. She had some great thoughts about the overall market environment. What happens when we have these quick and sudden bear market rallies, how to make sense of those, and where she sees opportunities today. Here's Erin Swenlin from DecisionPoint. All right, so Erin, what are you seeing in the markets right now? What's the big tell for you? How are we making sense of it?
Well, right now I think we're going to be dealing with this bear market for a while. Yeah. And one of the reasons I would say that is because we are getting a lot of bullish signals. We get our climax analysis will give us these really great upside initiations or downside exhaustions. Yeah. And our expectation is after that, you should see higher prices. Yep. We're finding that all of those bullish signals, positive divergences, which is what really called the end of the 2020 market, are not working out yet.
Interesting.
Every time we get them, the market fails. And so the bullish signals are not really coming to fruition. And so we believe that that's why we still have a lot of bear market force going on here, as far as the market. So we think that there's going to be more downside. Plus the bearish signals, man.
Working just fine.
They're working just fine.
It tells you a lot, I guess, right, about the dynamics, right? When things improve, if things change, the bullish signals are going to start to follow through. We're not really seeing that. Now, one area where we're not seeing upside follow through is in cryptocurrencies, right? You have Bitcoin sort of floundering 30,000, just a little below that, Ether right below 2,000. What do you see in that space? Is there hope for crypto investors? What do you think?
You know, if I'm looking at, because it's me, I'm looking pretty much at the chart and the technicals rather than the noise of what everybody's talking about. The technicals are very, very poor.
Right.
You know, we have a reverse flag. The flag is now turned into a descending triangle. You know, when we walked in this morning, I said, what's up with Bitcoin? It still hasn't broken support. But based on the flag formation, I mean, I'm seeing Bitcoin down at 10,000, which would be really harsh.
It'd be climactic.
It would. But if it loses the support level that it's currently clinging to, I would say, it's going to be really, really rough.
They've both sort of settled into that sort of consolidation phase, right? And they could break one way or the other. I'm concerned about that downside break. When you're, you know, I think one of the big stories of 2022 has been rising rates, right? That's been a huge impact on a lot of different areas of the market. Rates coming off a bit right now as bonds are rallying. What are you seeing in that area of the market? Well,
I don't think that interest rates are going to continue lower for very much longer. I see them turning back around and probably getting really up there. But right now, I think bonds are probably a good place because they are falling. Those rates they're in a declining trend. So I think there's a little bit of upside we're going to get out of bonds, but I just don't think it's going to be huge. I don't know if it'll be that profitable. I think a lot of people are kind of getting ready to go hide out there for a little while. But I don't think it's going to be a great hideout. I just don't. But in the short term, I think we'll be okay.
I think of it as sort of the fetal position trade, right? It's sort of hide out and try to navigate this.
I think once we finally see gold taking off, that really people are capitulating. Because that becomes the only thing that really has actual value.
So that's a great point. And gold is one of those areas of the market that really hasn't materialized, right? I mean, in an inflationary environment, you'd think gold is doing better than it is. It's sort of just stagnating right there. Is there hope for the chart of gold, do you think?
I think so. Right now, I think global conditions have really helped the dollar. And so with the dollar just, parabolically moving upward, it's really put a lot of downside pressure on gold. So even if people are coming in there, but we do gold sentiment and we look at the discount and premium for the physical gold trust. It's a closed-ended fund. And right now the discounts are still very high, meaning people are bearish on gold still. And again, I think it has a lot to do with the rising dollar at this point, but the dollar is starting to break down a little bit, and gold is starting to inch up just a little bit. But I'm looking for gold to do really, really well. I just don't know that this is quite the time because globally the dollar is just going to be so strong for a while. It's kind of the value out there.
Just to wrap up here real quick, where do you see an opportunity now? Is it things like energy that have already had a good run, or is it some of the defensive areas of the market that are starting to turn? Where do you look now?
Well, certainly not at reversals. I am definitely telling my subscribers trying to pick reversals up is just not smart right
Dangerous.
now. High risk. But I'm noticing some really great movement on my PMO for utilities and healthcare. We just got buy signals there. But I would try and stick to those areas of the market where we're already seeing rising trends, where we're already seeing those EMAs set up the way they need to be, because those reversal plays aren't good. But utilities and healthcare I'm liking right now. Energy, of course.
Perfect. Thanks again, Erin. It was so much fun to have Erin Swenlin in our office, and that just gives you a sense of some of the discussion that we've had so far today, and we'll do a little bit more of it tomorrow as well. But our take was really interesting, particularly the comments talking about how the bullish signals really don't materialize, but the bearish signals do, right? And it reminds me of the conversation we had yesterday with John Kosar from Asbury Research, right? The Asbury 6 model that he follows is all negative, which means you're just really not getting those bounces, right? And the bullish movements you do get don't really follow through it. And that's the phrase that we usually throw around on the final bar is follow through, or a lack of follow through. Wait for that to change, right? Today, you had a lot of consumer discretionary names bouncing for one day. Wait for that to continue and see some upside follow through. That's when you can, I think, stop being more defensive and start to be more optimistic about the overall environment. Great take very much by Erin Swenlin from DecisionPoint StockCharts.com. Let's continue on today's show here with banking on breadth. What we'd like to do is check in on some of the breadth measures that we follow. What sort of information can we gather by looking not just at the top level indexes, but the breadth, right, which tells you about participation, the stocks that make up those indexes. What are they telling us? When we talk about breadth, I like to start with the cumulative advanced decline lines. These are pretty commonly followed techniques, which are designed to tell you just that, right? The index is doing one thing. What about all the individual stocks that comprise those indexes? And a lot of times at major turning points, you will find that the advanced decline lines disagree. And usually the small cap breadth, or in particular the New York Stock Exchange breadth, which is the first panel below the closing price of the S&P here in red, exclamation point AD line NYSE. That's New York Stock Exchange common stock only breadth. A lot of times that will be a good leading indicator of what's happening. If you look at what happened in November into January, the S&P 500 making a new all-time high, the advanced decline line for the S&P 500 making a new all-time high. Everything's great. Look at the New York Stock Exchange advanced decline line making a lower high. So while the largest names, the mega cap names, were continuing to work going into the end of the year, into the holiday season, a lot of individual names below those mega cap stocks were struggling. We're not really confirming those new highs. What's interesting now is you almost have the opposite. The March low to the May low, the S&P has gone lower. The advanced decline lines have gone lower for all of these cap tiers, except the S&P advanced decline line, which has not done so. Interesting thing to watch, because if the S&P's advanced decline line never really gets below that support level, that tells you there's some underlying stability there. There's belief that the market is recovering, and it's manifesting itself in the fact that that the mega cap names, the biggest names, are not breaking down to the same degree that we see those other cap tiers. Now, generally speaking, I would follow the advanced decline line through the New York Stock Exchange more than anything. A break below the March low for the S&P's advanced decline line would be quite a negative sign for stocks as a whole. This is a sort of taking that cumulative data and just looking at individual days. So on any given day, what percent of the S&P, excuse me, this is the New York Stock Exchange, broader use list of stocks. What percent of them are closing higher? What percent of them are closing lower? You can see today about 78% of the New York Stock Exchange listings closed higher than yesterday's close. That's one of the highest readings we've had really in the last 6 months, right? This is at the upper end of the range. You rarely get above 80, even 90% based on this metric when you're looking at the broader New York Stock Exchange. Big list of stocks, pretty unusual that you would have all of them. If you look at this sort of indicator on like the S&P, you can more commonly get 90% swings just because of the breadth of that universe. So 78% is actually pretty encouraging. A recovery of the markets would have to see a lot more days like we've seen today. It can't just be a one-time thing. The other thing that concerns me, the last time you had this many closing higher was actually here. It was the first week in May, which was the last gasp of that consolidation period before a big day rolling over to the downside. So it's hard to signal an all clear from that particular indicator. Another breadth indicator that has me concerned is this one. We've talked about this one before. So looking at the S&P 500 with the 50 and 200-day moving averages, and then the percent of S&P names above their 200-day as of yesterday's close, just below 31%. What percent of the S&P above their 50-day moving average, just above 21%. Again, those are both as of Tuesday's close of this week. So while the S&P is well below its 50 and its 200-day moving average, about 1 out of every 5 S&P members are actually above their 50-day. 3 out of 10 of the S&P members are above their 200-day. So plenty of stocks are actually in an uptrend. If you think about in your brain, what would those be? Everything like energy and some of the materials names, some of the healthcare stocks that have rallied and have nice breakouts. Those are the ones that are actually above their moving averages. Even some utilities would fit into that, certainly fit into that bucket as well. That is encouraging, right? That there are some stocks closing above those moving averages, not so much, right? And here's the problem. That means most names are in an established downtrend. That means that we really haven't seen enough of a recovery for a lot of names to regain their 50-day moving average. And here's the kicker. If you look back to 2008, 2009, if you look back to 2001, 2002, these indicators both often get down to zero and even can stay there for months on end. When the market really gets negative, when we're in an established bear market phase, these indicators can go way lower than they've been. So I think if you're looking at this just at the last year, just at the last 2 years, it's going to seem like these are at all-time lows. That seems like a pretty good contrarian buy signal. Not so fast. And that's the challenge. If this does continue to materialize into more of a bearish phase, that indicator can actually go much, much lower. Just to finish off here with our analysis of breadth, the McClellan oscillator can be an interesting one because it's based on basically breadth data. It's based on the advanced decline data, but it uses some smoothing techniques, exponential moving averages, to come up with more of a consistent, what we'll call it, a robust analysis of the changes in the advanced decline line. So the McClellan oscillator really is an oscillator that revolves around the zero line. You can see that the zero line is the blue line in the background, horizontal line. You can see how this tends to chop around and go above or below based on how the advanced decline lines are fluctuating over time. It actually got back above the zero level about a week and a half, 2 weeks ago, and has remained for the most part above there. It's actually one of the rare things that are a little more constructive than we've seen elsewhere. The McClellan summation index, which actually smooths out the McClellan oscillator over time and is designed to more understand the long-term trends. Look at how long this has been trending downwards. And when the McClellan summation index gets above zero, that's when we can start to celebrate an all clear of sorts. That would be enough of a recovery that the buyers have come in and that has been reflected in prices going higher. We're nowhere near that yet. So overall, as we wrap up the segment banking on breadth conditions remain negative. They remain overall bearish. And we've outlined some of the things we would need to see to show an upside reversal, but not there yet. And bearish phases often see further deterioration, even from what we've seen so far year to date in 2022. Let's wrap the show. We go to the 3 in 3, 3 charts in 3 minutes that I feel tell the story of this current market environment. Here we go, chart number 1. In our segment, Banking on Breadth, we talked about the percent of stocks above their 50-day and their 200-day. This is a bit of a different look here. We're looking at the S&P 500 at the top, and I'm going all the way back to mid-2004. So I'm going back almost 20 years here. The first panel down is the percent of New York Stock Exchange listings above their 200-day moving average, currently around 25, 26%. Below that, the percent of S&P names above their 200-day moving average, currently 30, 31%. So where are we at right now relative to where we've been? So if you look back, we're at similar levels to where we were in late 2018, similar levels to where we were in the 2015 and 2016 pullbacks, even not too far off of where we were at the lows in 2011 and 2010. You can see in both of those series, that's about the case. Pretty encouraging because those are the major buy points, right? The major entry points that we probably get excited about going back over the last 15 years or so. Here's the problem. I skipped 2 really painful periods. One was the first quarter of 2020, where both of these indicators got down to single digits, and mid-late 2008, where both of them actually got down to zero and remained in single digits for about 6 months plus. So while we have come down quite a bit, and that's encouraging, if and when the market continues lower, an extended bear market phase, and again, talking with Erin Swenlin earlier today, we were reliving what the 2008 sell-off actually felt like, what 2001, 2002 looked like and felt like as technical analysts. I've seen when these indicators get down to zero and things get pretty painful, particularly that 2008 period. So am I saying we're going to repeat that? Absolutely not. But just the fact that it's come down to this point is not telling you necessarily that the downtrend is over. It could tell you we're just getting started. Chart number 2, EQT Corp. This is the top ranked stock in our large cap scooter rankings. If you're not familiar with the SCTR ranking, the StockCharts technical ranking, go to our chart school page and search for SCTR. You'll get a lot of information. We'll share our proprietary formula, how we combine different timeframes to percentile rank a group of stocks in a universe based on their technical characteristics, really measuring the strength of the trend. The top ranked stock in our large cap universe is EQT, which may be a name you're not super familiar with. It's in the E&P space, exploration and production within energy. It's about a 17 billion market cap stock. But what's interesting about this name is it's making a new 52-week high today. So if you ask about whether we missed energy, a day like today is once again reminding you, not necessarily, right? We're actually seeing further uptrend. And if you think of this as a bull flag pattern that actually measures much higher than current levels. Finally, AT&T, when I was talking with Erin Swenlin after we turned the camera off for today's interview, she mentioned, the one thing I didn't mention that I might have would be AT&T and Verizon showing some strength. So thanks again, Erin, for joining us on the show today and coming to our offices. And thanks for sharing that idea. AT&T breaking above resistance from earlier this year on a total return basis. Not bad. Special thanks to Erin Swenlin from DecisionPoint.com. I'm Dave Keller here at StockCharts. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.